Hi all, this week with Altimetry Macro Matters, Trump, tariffs and taxes, what people are not talking about.
And meanwhile, while everybody's focusing on that, Elon, everybody thinks he's creating chaos again. But if you've been paying attention, you know this isn't actually chaos.
The pharma industry and the costs and why Americans get charged so much more for the exact same medicine and pill that someone outside, and what's going to be done and how that's going to affect the pharma industry and which companies might be affected most.
Check out what we have to say about Amazon and how it's crushed earnings while Citi has decided that means it needs to cut the stock price by $2.
We'll look at Alphabet. They had a killer year.
And last but not least, if you think inflation is bad and you're worried about inflation in the US, wait until you see where we really think debasement of currencies is happening. That's what we'll wrap up with today. We're breaking it all down right now. Joel, Trump's tariffs and taxes, right? This is a big topic that everybody's talking about right now. What I know that you always have a strong take about this. What are you thinking?
One, that we've got lots and lots of experiments around tariffs. Tariffs just aren't going to be as bad as people think. I'm not just talking about tariffs being a negotiating tool, but even if they're put in permanently against places like China, when a country is actively pricing goods below cost and where their costs are also unfairly lowered because of slave labor practices, the cost of coal-firing energy because they don't pay carbon tax credits. What I'm getting at is when you have bad actors who are actively pricing below cost and the world buys it, it feels good because it says, oh, look, less inflation. These things are cheaper than they should be. But what you're really doing is sacrificing the industries. This happened with China with steel, where they're dumping steel at way below cost, and that led to a number of bankruptcies of steel companies around the world that are just gone forever. They did it with solar and photovoltaic. They're pricing that at 70 cents on the dollar of what it was costing anybody else to even try to compete. And no, I think the tariffs are necessary. I mean, they have already been pulled off of Canada and off of Mexico on top of that.
And I think, right, if you think about it from that context, and to your point, it made sense, right? All the Canada and Mexico is really just about, hey, let's reset the negotiating table, right? As opposed to as opposed to China, which was about, hey, let's re-level the playing field. But if I think, right, there's the other side of the coin, which, right, you're all the stuff that you always talk about in terms of the power of the U.S. government and the power of one of the biggest fulcrums that we can pull on, which is taxes. And putting all of these tariffs and what these are doing potentially to the economy in the context of what taxes can do to the economy. And I feel like that's the biggest story that nobody is talking about. Everybody wants to talk so much about tariffs, but taxes is really going to be the story if we look back in a year's time, I think, right?
Yeah, Trump understands the Laffer curve. He knows that Americans truly are overtaxed right now. When you think of it, we're really quintuple taxed. We're taxed when a business makes a profit. When the business pays the profit, it gets taxed again. There's been no value made, right? We get capital gains and dividends taxes on top of the company already paying taxes for generating that income. And then when you go and spend that money that you just made, right? You're paying excise taxes, which are buried inside the good. You're paying sales taxes. And then when you die, they're taking another 55% or something like that, right, from the money. And so in many ways, we're grossly overtaxed in the United States on just saying, I'd like to make some money and give it to my kids, right? And we want to see where these tax cuts go because I don't think he's complete yet. I think this is his first salvo of tax cuts. They're going to be very, very, very beneficial to economic expansion, which leads to increased tax revenue. The narrative that the media has, which is, how are you going to fund tax cuts? Tax cuts are funded 2 years later. They're funded by people making a lot more money, businesses expanding, making a lot more profit, right? And we saw that in the 1920s. We saw that in the 1960s under Kennedy. We saw it in the 1980s under Reagan. We saw it in the early 2000s under Bush, meaning tax cuts led to higher tax revenue. And we saw it again with the corporate tax cuts by Trump in 2017, 2018. So this idea that tax cuts make the deficit worse is just silly talk. It doesn't make any sense.
But as everybody knows, that's not the only thing going on with the government right now. Everybody is really talking about one person and one person only. It's actually not Trump. Everybody wants to talk about Elon and the chaos that Elon is creating in the government. And if you look, there's been bluster about Elon and in the Treasury, bluster about Elon with US aid, bluster about Elon with the Department of Education. And everybody thinks that he's just running rampage. But what everybody doesn't realize, and Joel, you and I have talked about this a bit, is what he's doing here is actually a pattern that he repeats, just everybody need to understand, over and over and over again. He's got, when he took over Twitter, and everybody has talked about the idea how his email, right, that he sent, that we sent out to all U.S. government employees about, resign or potentially risk getting riffed. How it was just like he did in Twitter, but this pattern that he had, he calls it his algorithm, if you will. He did it in Twitter, he did it in SpaceX, he's done it in almost every place that he's gotten control of his business. And look, it's always 5 steps, right? And this is the secret that nobody's talking about. It's step 1, question every requirement, right? He goes through the whole entire idea of getting access to the Treasury wasn't, some cabal. It's basically, hey, if you're a businessman who wants to figure out how to run your business, you need to understand where your cash is coming in and where your cash is going out. And then 2, right, delete every part or process you can. 3, simplify and optimize. 4, accelerate the cycle time. And then 5, automate. And look, we already just crushed through the first 2 steps of his process already. And if you want to watch what he's going to do, the biggest thing that I think nobody's talked about is he already announced, I think it was called GSAI. I don't know if you saw this, Joel. But so what GSAI is government services AI, that they're going to build out this AI solution. That's the secret of all this, is that Elon wants to basically take over those things. And I know from your conversations with Schaffner's and anybody who's following the news, it looks like he's heading toward the D.O.D. too, right, Joel?
Yeah, so a few things. One, I was an auditor, right, in the past. That's how I started out. And what he's doing is just basic audits that the government inspector generals and the general accounting office have not been doing. And then said, is the audit read only? All audits are read only. All you're doing is pulling up data and just saying, I want to look at it. And then they give him, heartache about saying, and you're just using young kids. All audits are run by young kids. You don't take someone who's a director of research who's 50 years old and have them doing basic audits. Audits are done for every company in America by the 23, 24, 25-year-old about to become CPA or fresh CPA. So what they're doing is good, and they should take this to every part of the government because they're really low-hanging fruit. You don't even have to put an XAI into this sort of thing. You just need people looking at the data with open eyes and saying, I'm going to call out when I see something strange.
Yeah, and I think it's a really good point, too, because everybody is, up in arms like, oh, he's shutting down this spending or that spending. No, what's going on here is not that. What's going to end up happening is all of the inefficiencies that are happening with the government. It's about, let's get into the weeds and figure out the numbers and everything else. And I think it's an interesting, it's an interesting fact, because when you look at what's happened to all the defense contractors, since November, a bunch of them are off, 10, 15% or more from where they were, because everybody seems spooked about this narrative. And I think what everybody's missing, which is so important, is everybody's focusing on what DOGE is going to do for defense, and it's not that. What they're trying to do is find efficiencies and everything else. And the flip side for all these defense contractors, well, everybody's spooked that DOGE is going to attack them. Everybody's not paying attention to what Trump is talking about on the other side of the equation, which is Trump has been beating the drum on the idea that, hey, we need our partners in NATO, for instance, to carry more of the weight to be able to, for the defense spending that we're doing. And so people are, worried that it's Lockheed Martin or is somebody else going to, basically get taken out by DOGE. And the reality is, no. What's going to happen is we're not cutting the amount that we're spending with Lockheed Martin in terms of defense spending. And because of what Trump has said, right, historically the spending for NATO, right, has been targeted at 2% of GDP. And Trump said he wants it to be 5%. Of course, nobody's actually going to go to 5% other than maybe like Lithuania, because they're actually worried about the Russians marching in like they did to Ukraine. But look, when we've got all of the rest of NATO saying, hey, we got to spend money on defense kit to get those, right, spending relative to GDP up, what that means is, guess what's going to happen? Lockheed Martin, which, by the way, everybody, Lockheed Martin recommendation, our Hidden Alpha newsletter that we put out is a recommendation that we like. Lockheed is not priced for that at all, right? Lockheed and everybody else, people are worried that they're going to get whacked. And actually, in reality, Trump's probably going to be better for Lockheed than not. Don't you think, Joel?
Yeah, let me explain this Lockheed Martin chart for anyone that doesn't, it's not aware. So this is Lockheed Martin. This is under uniform accounting. This is the true profitability. This is not the nonsense you hear on CNBC or by Wall Street that are still beholden to GAAP accounting, generally accepted accounting principles, which none of our institutional clients would ever rely on in a million years. I'm telling you, our institutional clients laugh about people using generally accepted accounting principles and earnings calculated the way it is on television and by Wall Street. So they're using this uniform accounting or something very, very, very much like it. And it says Lockheed Martin has 20+% return on assets. I mean, think of your bank account paid you an interest rate of 20+%. This is a very, very profitable company. But what's priced in is that the analysts believe, and not our analysts, but the total analysts of all the analysts covering Lockheed Martin think that that return is going to fall to just above 20%. That's the shaded blue. The dark blue is history. The shaded light blue is what the analysts are expecting. And then to get to the current stock price, this is a reverse engineered. This is not a forecast. This says to get to the current stock price, you would need those returns to keep falling down to 17+% return while the whole world is spending more in defense. And just because of Doge, I don't believe it. All right. So we like this stock because we think what the market's pricing and what you're looking at is like sort of setting the line, right? It's not saying who's going to win, who's going to lose. It just says when you know, like the Super Bowl, it's saying how much will one team win by. And what this is saying is this is what is priced in. This is the over-under. If they hit returns that are above this level of profitability, meaning if they just stay where they are right now, this stock has upside. And for the stock to have downside, you need the returns to collapse more than these white bars are showing. That's what this is. It's setting the line. And that's why Rob and the team, the investment committee team inside Altimetry, like this company so much.
Exactly. Now, and here's the thing. The defense world is not the only place that I think the U.S. is catching on that we need to level the playing field a bit, because the pharma industry is another place that this is just wild statistics. You know, we in the U.S., we talk about 18% of U.S. GDP is spent on healthcare. Well, I know, Joel, you know this, but I just want to run through these because they're wild. Let me just give you some numbers in terms of where it might be that those numbers are coming from in terms of why it is that we spend so much. So let's talk insulin, right? So insulin, the U.S., for 100 IUs, right, in terms of international units, cost $23 a vial, right? Net, in terms of after you basically pay for everything, it's $5 and change. The rest of the world, insulin costs $2.30 on average. Let's talk about Advair. Advair is an asthma inhaler for those of you who are lucky enough not to know what it is. Advair in the US, an inhaler, $187. Rest of the world, $40. Xarelto, right, blood thinner. US treatment, $471. Rest of the world, $65 to $80. And this is the one that kills me.
Maddening.
That's why this
really.
But this is the one that kills me. So Harvoni, right? So Harvoni, amazing drug that Gilead came out with. Probably my God, this was probably 10 years ago at this point. But the first version of this, Harvoni, and all of the other versions that Gilead came out with. Harvoni basically cures hepatitis C, right? So and some other liver diseases also. But Gilead prices it in the U.S. like, hey, we're curing a disease for you, so you're never going to have to take anything anymore. Harvoni in the U.S. costs $94,500. In India, it costs $900. Now, look, in the rest of the world, developed world, it's $39,000, but that's just nuts, right? The idea that the U.S. on average, if you look across all drugs, branded drugs, the U.S. on average pays 4x what the OECD does. And so this is this wild story that's going on here. And, you know, Joel, I think this is the story that go ahead.
Just to make a point, we're not against even the pill being free, right? If you're taking it to Vietnam or Cambodia or places where they have little access to hospitals or whatever else, you're like, hey, we just cured Hep C, right? But why are the Europeans paying a third of what Americans are paying? That doesn't make any sense, right? So you've got some of the highest earning countries, the highest per capita wealth in many of these countries, the Norwegians or whatever else. Why are they paying a third of what an American's paying, right? With sovereign wealth funds that are in the trillions of dollars, and they're getting the pills for a third or a fourth or a fifth? That doesn't make any sense whatsoever.
Right? I mean, and this is the story, right, when we talk about, Trump and fairness, I think this is one of the ones that he talked about this, Joel, like right before I think he got into office in early January. But right, he's saying now, right, the rest of the world, right, the free ride is over for U.S. healthcare.
Trump is correct on this issue.
And so when you think about, right, for a long time, everybody has talked about the idea that, wow, pharmaceutical companies look so cheap. And right, if you look at it in terms of what market expectations are for pharmaceutical companies, if you remember what, Joel, you were talking about earlier when you talked about the dark blue bar and the white bar, right? So we just really quickly did is we said all the big pharma companies other than Eli Lilly, because Eli Lilly and GLP-1s are a very different story that we can talk about some other time. But all of the other kind of mature big pharma companies, we looked at what is their level of profitability in 2024, right? And you can see it's basically comes into the number of about 18% in terms of the return on assets, our cleaned up accounting return on assets for these businesses. And the market expects that to fall to basically 14% levels. And Joel, I look at this and I look at the noise that Trump has made about, hey, one of the ways that we can bring down healthcare costs is stop paying so much more than everybody else does, make other people pay more maybe, but we're going to start to pay a little less. Makes sense, right? Where people are thinking that ROAs for these businesses are going to collapse, right?
So basically what Rob said is other than the two GLP-1 companies, Novo Nordisk and Eli Lilly, who have expectations of profitability, right? The fat drug, the easy way of losing weight. I know people are not going to like me for saying that, right? But other than proper nutrition and exercise and good sleep, if you want the easy way, which most people do, right, then Eli Lilly's doing so well. But all the other pharma companies, when you start looking at these charts, have underperformed the S&P 500 for the last several years. Other than Eli Lilly and Novo Nordisk, it's hard to find a big pharma company that's even kept up with the stock market because they're not in GLP-1s, and all their other drugs are saying, what's more likely to happen with what Trump is doing? Is it more likely he's going to be able to get India to pay $30,000 a pill, right, for Hep C instead of $900, or it's more likely that the $94,000 number in the U.S. comes down? And what ends up happening is pharmaceutical companies make less money per dollar volume of medicals.
Exactly. And all right, for a subject change that goes a completely in a different field, but Joel, one of my favorite pastimes, picking on the stupidity of Wall Street analysts.
Wall Street wrong again.
Right. Let's talk about some inane commentary from Wall Street, Citigroup specifically, on Amazon a week or two ago. When Amazon came out with numbers, and Citigroup, this is awesome. Citigroup said, we are incrementally positive on Amazon after Q4, but we're going to cut Amazon's stock price target by $2. So it's not worth $275 in our view. It's really worth $273. But we're incrementally positive on this company. That, I mean, Joel, right? They blew out numbers and we're incrementally positive but cutting prices. How does this even make any sense?
So first off, across Wall Street right now, we took every one of the 50, 60 biggest banks, and that means we're getting little banks too. And we took every recommendation. So we're talking about 10,000 ratings. Rob, right now, how many of those ratings are buy and hold versus sell? Wild guess. I'm
going to say 99%. Maybe a little bit of exaggeration, Joel, but tell us the real number.
Yes, 94 to 95%. Right? 94 to 95%. There is a disconnect. When you read enough Wall Street research, there's always a disconnect between the buy, hold, sell recommendation. The buy, sell recommendation will often have no relationship to what their target price is. And then the target price will have no relationship to their actual pro forma financial forecast that they put in the back. And so the issue is when you look at Wall Street research, it's like three different humans reporting three different things in one report, even if the team is, one analyst. And we see this all the time where the commentary will differ from the price target, will differ from the buy-sell recommendation, and the pro forma financial forecasts that are in the back. In fact, Rob, I'd say the most valuable part of the research are the pro forma financial forecasts that are in the back that nobody ever looks at. No one ever looks at that where they actually show up their industry expertise, like line by line, 1 or 2 year forecast.
Right, and to your point on this one, it's like, right, for Citi, they go, hey, we're cutting our price by $2. Again, $2 on a $275 price target. That is like literally nothing. And they said they were incrementally positive. This is a company that beat revenue by like $500 million. Earnings came in like 40 cents above expectations. And all that's the stuff that they're actually talking about. But then they go, oh, but while the buy is there, we're still reducing the price target. And if you look at the data,
there's no
right?
justification. I mean,
right, based on
I'm saying they have not made a justification for it. Just the stuff is, and this is always the case with Wall Street research. They don't combine, they don't match.
And what you dig in with us for everybody, which is what's so interesting, is Citi is walking back their guidance for this. So, right, coming back to the idea of this embedded expectations data that Joel was talking about earlier that we show up here. So for Amazon, when you look at Amazon in terms of embedded expectations, remember those dark blue bars are what the company did historically. Amazon has been floating around a 10% return on assets. But thanks to the AI boom, mostly, right, in terms of the huge demand for AWS that's exploding, as kind of Amazon being the neutral party, right? Because if you go with Google, you kind of are tied in Gemini. If you go with Microsoft, you're kind of tied in with either ChatGPT and OpenAI or with Anthropic. But Amazon is kind of like, hey, you can use us for whatever you want to use us for. So people are using AWS, the secret power of engine for the business, and because of that, return on assets has been actually accelerating a lot. What those white bars are, just remember again, is at Amazon's current stock price, right? At Amazon's $2.5 trillion current market cap, what the market thinks the company is going to do. And so the market is expecting returns to rise right now. But what's really interesting is if AWS keeps on ramping, that ROA acceleration is going to keep on going up, not slowing down, which is what the market's pricing in. And so for Citi to be like, oh, with news this good, because it's a company that beats by $500 million on revenue and 40 cents on EPS, that's a company with improving fundamentals, not declining it. And for them to go, oh, well, this means we need to walk down the price target by $2, it's just ridiculous.
And Rob, you just allow me, right? So what you're looking at under the altimeter, right, are what 230, the biggest 300 institutional investors in the world are looking at, because they're not looking at gap accounting. They're not looking at the stuff on Bloomberg or FactSet or the generally accepted accounting principle driven numbers. This is the return on assets under uniform accounting, where every company in the world gets the same accounting. They don't get different electives and different rules. They get all the same rules. And what you find is the dark shaded blue bars, Amazon is around a 10% return business. A little bit higher, maybe we go back to 2019, but around a 10% return business. They've been investing like crazy into AWS. AWS is the best cloud platform. That is what I know a lot of consultants and all the tech consultants tell me AWS still remains the best cloud platform. So if you think the company is with AWS and AI and everything that's happening, AI's usage of Amazon tools and products, that they're going to exceed their historical return in 2019, you would say the stock is a screaming buy. Now you decide. Do you think Amazon's going to get back to better than 2019 numbers? Or you think that the returns are going to fall off and costs are going to exceed whatever? That's what the line is on Amazon.
Well, no matter what the line is, Joel, I think that clearly after that earnings report, our target price for Amazon should be $2 lower than it was beforehand.
That's what Citi says, and it's just silly talk, really. I don't understand it at all. But that's also wrong. It seems like we're picking on Citi. We could have picked any one of 40 different analysts this week who said something just as ridiculous on CNBC, on television, in the reports for us to make fun of. But we picked on that one because everyone looks at Amazon all the time.
And but Amazon isn't the only one who had really good news this most recent week or two, but people are focused on the CapEx story. Joel, another one that you had been talking to me about is Alphabet and what you've seen in terms of how people just aren't understanding what's really going on for this one too. Can I jaw a little bit on it?
We call this earnings uncensored because we're giving you the earnings the way the big institutional investors looking at it, not the way that CNBC and Bloomberg or whatever report on television, the gap accounting, which the SEC requires, but it's wrong. Every great investor knows it's wrong, from Buffett to Klarman to Munger has said it's wrong. Marty Whitman said, don't trust gap accounting at all. It's not truth or reality. So anyway, when we do these earnings uncensored segments, we're saying, here's an unvarnished view of really what's going on. And when you dig in, you see that Google, Alphabet, is still going to spend, they had $100 billion bottom line, but they're still going to spend $75 billion in capital expenditures. That's AI related. Those are chips. Those are chips to the nth degree. So an idea that because of DeepSeek, people are going to stop, buying chips from NVIDIA or from AMD or from anyone else is just crazy. No, I mean, if anything, you see a ramp up. And this is an announcement just recently, right? This is post DeepSeek. They're saying, by the way, we're going to spend $75 billion. That tells you something. It tells you they looked at DeepSeek and they said, all right, yeah, there's some interesting things they did that I wouldn't recommend using DeepSeek at all. But if you look at the underlying code, the hardcore tech people are like, programs are like, yeah, they did some interesting things on inferencing that probably is a bit more efficient, maybe a lot more efficient in some ways. But it doesn't mean they're going to stop buying chips. The world is going to stop buying chips. And by the way, DeepSeek they did, right? They used the NVIDIA chips to do what they're doing. They were able to sneak a lot of them in just before the export controls.
But there's this idea that when you make something cheaper, right, people don't use the same amount of it. They use more of it. And so even if DeepSeek actually isn't as cheap as it claims it is, let's say that it isn't, right? But it's probably giving us incremental innovation. And there's going to be a ton of other stuff. I think Llama literally just recently came out and said that it was able to now drive prices down that much because of some of the insights that they saw from DeepSeek, Llama from Meta. All this stuff, when you make stuff cheaper, it means you use more of it. And so that doesn't mean you need less chips. It actually means that the adoption curve can go even faster in terms of, right, this idea of Moore's Law, right? You basically, when you make it cheaper to do something, people do a lot more of it. And so everybody who's worried about the investment is missing stuff. Yeah, go ahead, Joel. Sorry.
So what happened in the 1970s was the U.S. said, we're going to put in mandates that vehicles need to have better fuel mileage, meaning you'd be able to go better, longer, and faster, meaning that should allow people to travel further on less gas, which will then lead to what the government thought, less gas consumption. But that's not what happened. What people said was, oh, I can now travel further with less gas. Well, then I'll use more of it so I can live in the suburbs and I can super commute and I can get a bigger house with a bigger yard or a bigger apartment and just spend more time driving. And people literally traded, right, with that gas efficiency. They traded their time, which you would have thought people value, right, for living further from office, living further from work, living further from wherever, so they can do that. And so we've seen this happen before, right? Making things more efficient can lead to a lot more usage, like is what happened obviously with fuel, not by making fuel more efficient, which the government mandated, that they thought, oh, people use less fuel because it's more efficient. No, they use a heck of a lot more of it, as we all know.
No, and this comes the idea of, so anybody looking at, Amazon or Alphabet, Google, or Microsoft and saying, hey, all this CapEx spending and DeepSeek is a worry. And that's actually, so again, coming back to that idea of embedded expectations and what the market's pricing in, right? We've got Alphabet up here in terms of historic profitability for the business, blue bars, light blue bars, what the analysts are forecasting. And those white bars are what the market's pricing in for the company. The market for Alphabet is pricing in as though Alphabet is not going to see a bunch of demand growth from AI, and all of the investment that they're making is going to actually lead to collapsing returns. Worried about search or anything else, not realizing, look, one, Gemini is better than people grasp, but two, more importantly, doesn't even matter if Gemini is better than people grasp. We're going to have a lot more people using AI, and Alphabet's going to be one of the primary dealers of cloud space for you to do it. The white bars here are just too low and too pessimistic for this company in the context of all of that backdrop of investment and demand growth that you were talking about, Joel.
Again, we're Wall Street, we're bookies who don't take bets. We're the Wall Street bookie analysts. And what we're saying is, if you believe that, $197 a share, right, is the correct price for Google, for Alphabet, then you believe in this forecast, because this is just reverse engineered. This is taking, to get to that stock price, you need this kind of ROA profile over the next 5 years, which means it's going to drop quite a bit. If that's what you believe, then great. Now, if you think that 5 years from now, you'll look back at this chart and you'll see those blue bars soaring above where the white bars are right now, then you ought to be buying the stock. Now, if you think you're going to see these, 5 years from now, you're going to look back and go, oh, the actual bars have fallen below that line and they're below 20%, then you run from the stock, like crazy. And that's what the setting of the line, that's the value of this that we think is for our clients.
Exactly. Now, well, the world of cloud computing has certainly been capable of deploying a lot of capital and deploying it efficiently. Let's talk about another industry that historically has not done a very good job of deploying capital into themselves, even though things have changed recently.
Paper,
So,
basic
yeah.
chemicals, steel.
Yeah, what? Yep, but not
guessing.
all those. Let's go to airlines instead. So Buffett has this
Oh!
awesome quote from 2007 where he basically said effectively, hey, you know what? If I wanted to do a favor to capitalists, I'd go back in time and I'd murder the Wright brothers so we didn't have any flights. That's not actually what he said, but that's what I'm interpreting from his quote, which is a far-sighted capitalist would have gone back to Kitty Hawk and shot down the plane. But effectively, the reason why Buffett was saying is because he's like, look, all of these companies, he was saying at the time, just consistently are piles of capital that are being lit on fire. And then here's the best thing. 9 years later, Buffett turns around and spends over $1 billion buying American Airlines, Delta, Southwest, and United. So what gives? Right? What gives in terms of what on earth was Buffett thinking after literally saying the best thing that could ever happen to capitalists would be if the Wright brothers never existed? Well, he was looking at this. And so what this data is that we're showing you is so uniform return on assets, right? That profitability metric that Joel and I keep on talking about. When we clean up the accounting, we see what real profitability is. Cost of capital, right? The bare minimum that companies need to generate for investors to be happy is around 5%. Airlines historically, plus or minus 5% ROA businesses, return on asset businesses. But something really interesting happened in the early to mid 2010s, which is Delta specifically, but a lot of the other U.S. airlines stopped being cost of capital or worse businesses. And there's a reason why, quite frankly, they did, right? And you can see it here. The data here shows that basically return on assets for Delta was 10% or better for basically the entire 2010s. And Joel, I'm sure that you know what we're going to talk about in terms of the reason why. But really,
Well,
if I look at it, yeah, go ahead.
Well, they say, so what happened was management teams got two things, right, that changed the profile of an industry that was always going bankrupt, right, every time there was a recession. It's like, you know that you're always going to have a recession. It's not like they're going to go away. So why are you taking out so much debt, thereby putting yourself at risk of bankruptcy every time?
Yeah.
So two things that the airlines discovered sometime in the last 15 years is they found religion over overspending and debt levels. They say they found religion, but it's like they totally changed their mind. And two, they found collusion.
I think that we're missing the bigger story, which is actually the third leg of what they did. So the third leg of what all these airlines figured out, everybody, was they stopped being airlines. Right, there's this wild data that came out recently that was from it actually came out in the FT. But sorry, go ahead, Joel.
They stopped relying on their airline business.
Yes.
It's hyperbole. They didn't stop being airlines, but they stopped relying on the flying people from place to place business as being their source of profitability, because they realized the promise of flying from place to place was far more profitable than the actual flying from place to place.
Exactly.
Yes.
And what we're talking about, everybody, is airline miles, right? So what basically happened in the early 2010s was the explosion of the value of these airline miles programs, right? Sky Miles for Delta, A Advantage, United's Mileage Plus, right? Whatever Southwest is. Why anybody would want Southwest miles is beyond me, but that's just my opinion. But so if you look at it, we're at the point now where Delta Sky Miles is literally half of the total enterprise value of Delta. For American, for A Advantage is worth more than 2 times American Airlines market cap. That is absurd. And right, what that tells you is these companies have stopped being airlines. And I think that's what Buffett saw. Buffett saw, hey, look, they're getting oligopolistic, but two, they're getting away from that idea of being we're battling over channels in terms of we're battling over routes, and they're getting to we're going to have a reason to be sticky for customers. But, and this is where you get into the really interesting thing for airlines is that was great for airlines for 10 years, but I think, Joel, really, and you're the person who knows best about this, but I think airlines, in terms of the success of the mileage business, it might be running out because the fact that they've been victims of their own success, right? I mean, let's just talk about you flying from New York to Manila on Cathay Pacific and how much it cost in 2018 versus now.
what Rob is referring to is a side argument, a side discussion that a subscriber had with us, a client. They said I'm looking at the currencies, and the yen has gone from 110 to 150, and the dollar, there's been inflation, which is reducing the value of the dollar. Everything costs more. When you go across the world, right? They said, so what's the worst currency? Is it the Turkish lira? Is it the Argentinian, right, peso? Or is it the Boulevard? I said, no, hands down, it's mileage. And they said, what? I said, the currency of miles, of airline miles, has inflated, meaning devalued, right? Inflation in how many miles you need for a seat going anywhere has gone up worse than any currency you can imagine, right? So if you're sitting on a bunch of miles and points, you probably have noticed that you'd say, oh my goodness, it costs me a lot more miles. That is inflation, right? That means currency devaluation to do that route. And Rob was talking about that route of, it used to be that you could fly from New York to Hong Kong nonstop in business class for like 80,000 miles on Cathay Pacific using American miles. And today I was looking at that same route. It was 450,000 miles.
It's stupid.
450. That is the worst devaluation of a currency that I can possibly think of in history, except for maybe the Weimar Republic or Japan during World War II and the Japanese yen. It rivals that in terms of devaluation of a currency. And that's what's happening with airline miles across the board, really, since the pandemic.
That is a definition of hyperinflation right there. And so if you want to talk about the real currency deflation, debasement, everybody, it's not the US dollar anytime soon. It's definitely that. And I mean, this is the thing is, so if you look at all these airlines, with them having so much of the value of the business tied up in credit card companies paying to buy those miles, when people and a lot of frequent flyers, Joel, right, are realizing this, they're saying, hey, it's just worth a lot less. You're going to see that going. You're going to see that going away. So that actually could be another bear thesis for the airlines.
That said, I mean, when you think of it just on a current basis, all the affinity programs are paying the same amount of money, 1 cent, 2 cents, whatever, 0.8 cents per mile as they used to. They all are.
And the value
but
of
those
miles.
exact cost of miles is buying you so much less seat, so much less hotel room, so much less whatever, car rentals you might have been using your points for. But really the airline seats is where you see the hyperinflation in the use of miles. And so when you think of it that way, the airlines are saying, hey, look what we did. We collected the same amount of revenue and we're giving up less free seats in the future for that same amount of revenue. Now, what Rob is saying is, how long can that continue before people go, you know what, I don't care about your credit card program, and the credit card programs have to find some other affinity because they're like, those American miles or those Delta miles just aren't worth that much. So promising me I'm going to get a bunch of miles, and I got to spend $450,000 to get 450,000 miles for a round-trip business class flight? That doesn't make any sense to people. And so at some point, we think the affinity programs might break because of how little, or you're going to see, a unbelievable currency revaluation where the airlines go, sorry, we're going to bring it back because it's such an important business for them. Something's got to give.
But either way, everybody, you didn't think that we were going to start talking about Trump tariffs, and then when we got to talking about currency debasement, it was going to be talking about airline miles. But there you have it. So this is our first episode. Everybody, we hope you come back, and thanks so much.
We hope you enjoyed it. Thank you. Let us know what you want to hear about. We're happy to talk about it.